This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Bert, Dohmen, publisher of the very well-recognized Wellington Letter, who's hasn't been on in a while, but every time he's been here before, something dramatic occurred in the markets, and Bert, it seems this time it's no different.
Yes, somehow you picked the moment exactly right.
Last time it was China and what was happening with credit, and this time it's the U.S. markets. Bert, we have so many new listeners since the last time that you were on. Could you give our listeners a sense of your background, your writings, and what your current involvements are?
Okay, I started my firm in 1977, so that's a long time ago, and I've been using technical analysis extensively since I was in graduate school. That's when I started investing with very little money. I only had $400, but I found out very quickly that fundamental analysis really needs to be improved on. And finally, I found a book on chart analysis, and that actually was the only book at the time in the entire library of the university. And so that's because my degree is in chemistry and science. I love looking at charts, and so that's the thing that made sense to me, because what you do in technical analysis, you're measuring the change in the price-demand relationship. And change in price and demand is the only thing that can change the price of an investment. So if you know what the money flows are in or out of an investment, then you can make the proper investment decision. You don't have to be even concerned about 50 or 100 different economic indicators. So we don't manage money. We are not brokers. We give totally impartial advice, and we can even use the word sell and sell short, which we have done very successfully. We've been fortunate enough to forecast every meaningful decline in the stock market over the last 36 years. So that's what we do. But I also do look at the economics, but probably a different perspective on the economic indicators than most economists use. You know, I don't really think much of the traditional stuff like GDP and so on. These numbers are all so phony. They're all massaged quite extensively by the various governments. I look at the credit. I think credit is the one thing that's very important in the markets. So that's what we do.
You stand out clearly amongst others because you do such a job of combining macroeconomics with credit markets and credit understanding with the technical analysis and bringing all three together so well. That really show here, I'm sure, to our listeners, we go through the charts this morning. But a point you made earlier about when you first started about fundamentals and then really getting into technicals, and how I look at it is the difference between reality and expectations. Fundamentals, you can do a great job, and this is the reality, but it doesn't tell you what's going on or what's going to happen because that's matching up expectations. And the technicals really give you a sense of that from a sentiment and a behavioral standpoint. Do you agree with that?
Exactly. I think you put it exactly right. I couldn't say it better.
I've got a chart up here showing the various graphics that you brought with you. I'd like to start with the macro analytics side of it to give a better perspective before we actually look at some of the technical analysis charts. So I have the Baltic Freight Index up, and there aren't many people that have been talking about this, but I've been watching it here for 60 days now, and I'm just stunned that people aren't focused on it.
Yeah, the Baltic, you're measuring the freight rates for transporting bulk goods, not containers, but bulk goods. There's another index, the Harpex, which is for container goods. We also look at that. But this is a direct reflection of global trade, whether it's diminishing or it's strengthening. And late last year, everyone got so excited in the media, all these economists, the Baltic index is rising. That means that the Chinese economy is in great shape and so on. And, we said at the time, not so fast. This means absolutely nothing. The Chinese economy right now is in a private sector recession. You know, if you just take out the governmental portion of the economy, China is in a recession. We said that last year. And the dividing line was June last year. That was the first credit crisis in China. They did a good job afterwards of hiding the consequences. We said, once you have such a monumental credit crisis where short-term interest rates tripled overnight, went from 7% to about 24, 25%, is that that's it. The repercussions of that are that no one can get loans anymore. The banks will just shut down lending, and when you shut down lending, you shut down the economy, and that was it. Now, the government after that started fabricating some artificially bullish numbers and so on. But as we know now, that was all phony. So the Baltic now has come back down, and here you can see that the Baltic index, the short term, which is the first chart, did plunge back down from 2,300 to 1,050. So that's more than a 50% decline in freight rates in basically a month. That's huge. And again, in 2008, these very large freighters, you know, the bulk carriers for oil, and I think they're about 1,000 feet long. They could actually, you could rent those for less than it cost you to rent a yacht on Lake Tahoe. We wrote about that. It was absolutely incredible. So these indexes are very important. Our prediction right now is that freighters will again, they will again be at anchor, empty, with no shipments to transport, and that should come here before year end.
Bert, point on that, a lot of the mainstream analysts were continuously poo-pooing this dramatic longer-term drop in the Baltic because of and their argument was the amount of new ships that were coming online and into production, and therefore driving the costs down. To some degree, there's certainly an element of it, but it really misses the bigger picture. But in your short term of what's happened in 30, 60 days has nothing to do with that many ships being arrived. It's very, very clear of what I believe is an accelerating global slowdown. Yeah,
exactly. And you know what's going to happen now? Next year, you're going to have a 16% increase in freighters and ships. 16% increase. This year, I think it's about half that increase. So you're going to have more and more ships out there and less goods to transport. In China right now, they're having a big credit crisis, as you know. Many companies are not able to get letters of credit from their banks. They just turned back, I think it was 300,000 tons of soybeans. Shipment had to be canceled going into China because the importer could not get a letter of credit from the bank. The banks are just not doing anything in regard to credit anymore. They don't want to take the risk. Now, that is exactly what we saw in 2007 and 2008. Shipping just froze up because nobody could get a letter of credit anymore. So it's starting again right now. So you're going to have less demand for ships, and you're going to have more ships coming online.
You're the first one that's mentioned that, Bert, but that's exactly what happened in 2007. It was shipping letters of credit. And, you know, in China, the people in the biggest troubles right now are the steel producers. And guess where that steel was being used? There's a tremendous amount in shipbuilding. So it all ties together.
It all ties together. This is the ripple effect. And it all comes from the credit markets. You know, you mentioned it before. The credit markets are so important because everything comes from, when I see all these bulls on TV talking about earnings, you know, come on, earnings have nothing to do with it. You can have the greatest company in the world with the greatest earnings. When there is a global credit crisis, those earnings will vanish, you know. So it doesn't matter. The credit is the most important thing for the global economies. And when you get a credit crunch from the enormous credit bubbles that have been created over the last 5 years by some of the major central banks like our Federal Reserve and like China and now Japan, etc., you are going to have some severe pain when these credit bubbles burst. And they are now bursting.
Bert, we have an article or a paper up on our site called Pay Attention to the Credit Markets. And in the end of March, it was showing us a trigger point that it was time to short because of the deviation between the credit markets. And it was a regression credit default swaps in emerging markets, high yield, and 5-year swap spreads as a regression. And it's been just worked out perfect on this short-term correction that we're currently in. And by the way, it says there's more to go for it to close the spread, but it's also signaling a much longer-term topping process.
Yes, when you talk to some of the credit experts in the U.S., they are looking at the U.S. credit markets, and there is no stress yet. And they're forecasting another 2 years of a bull market in stocks and a nice economy, etc. But they forget that we are part of the globe. The earth is flat, as someone wrote. And when China is in a credit crisis, it's going to infect the entire globe. I wrote a book about 18 months ago called The Coming China Crisis. And it predicted exactly what is happening right now. And it said this is going to infect the entire global markets. Don't look at the U.S. markets if you want to see if there's going to be a bear market or a recession. It's going to come from abroad, and it always comes from where people are not looking. When everybody's looking at the credit instruments in the U.S. and the junk bond spreads and all of these things and so on, they're looking in the wrong direction. They want to look at this because that's where the signals came from last time. This time, when you're looking to the right, the real problem is going to come from the left side and eat you up.
What a lot of people really miss is in China versus the United States, and you're more of an expert in China than I am, but the United States is a consumer-oriented economy, 70% consumption, and it's being credit-driven. China is not a consumer-oriented. What it is in its GDP is investment, and it's capital investment. And that capital investment is so disproportionately out of line compared to other countries. And that's been good. But when capital slows down, and it is now slowing, how do you replace that in the GDP formula? You can't get that much growth. So what they've been doing is the same as we've been doing it, is extensive explosion of credit. And a lot of people may not appreciate, but the credit growth in China makes the United States just look like we're paupers.
It is huge.
It's massive. Very few, Bert, really appreciate that.
It's estimated that they have over $21 trillion worth of loans outstanding. And it's estimated that about half of that, around $10 trillion, is in a shadow banking system, which is totally unregulated. Therefore, they don't even know where those loans are. Those loans have been made by these wealth management companies organized by banks in order to circumvent the regular banking system. So you've got $10 trillion of loans out there. They are now defaulting one after another. It's an avalanche of defaults and so on. And the government can't even go in there and say, okay, we're going to absorb all of these defaults, because they don't even know where the loans are.
When the implosion happened with us in 2007, 2008, the Federal Reserve, whether you agree or not, jumped in. And remember all little acronyms that they came in with? There was 10 various types of programs that the Fed put together. But they were able to do it fairly quickly, but they all targeted very specific areas of the shadow banking process. And not many people appreciate that. And one reason I'm bringing it up is they can't do that in China. They have total lack of visibility to the growth of that credit. So as it's starting to implode, and it is, and we just recently saw this on the leverage and commodities, they don't have the ability to fix it as rapidly, is my estimation, because it's so much less a mature capitalist system. I don't get me wrong, I think China in the long term is going to be just fine, but they just haven't put the infrastructure financially in place to manage it.
I wrote in this book, The Coming China Crisis, I said, China has now hit the great wall of communism, and that is the end. And, the Chinese are such entrepreneurs. They are so intelligent. They're very hardworking, etc. But they can't go any further than they have. They've done all the catching up, 100 years of catching up with the Western world. They've gotten all of the technology of the Western world basically free. And that's it. But now is the period when the entrepreneurs should be taking over, but they can't. Communism is there. Corruption is humongous. And so nobody, I mean, this one person they just charged with corruption. He was a top security chief and a party official, etc. And he's accused of taking $14.6 billion with a B. That's huge. He had over 300 condominiums. So, with that kind of corruption, the economy cannot function. Because as soon as you start a company that interferes with the business of one of these SOEs, which are the governmentally owned companies, that governmentally owned company will put you out of business. So that's where China is right now. I don't buy the story at all that it's going to be the biggest economy in the world over the next 5 years and so on. It's not going to happen. They are up against some very serious problems.
Back to credit. I have U.S. Treasury long bond with a neckline on it up on our screen.
The T-bonds right now, we have we have 6 different subscription programs, 2 of them for very short-term traders. We also have one we call private portfolios, which actually allows people to manage their own money. We give them a model portfolio. And for the first time in a number of years now, on March 24th, we went 100% into cash or equivalents. And so we sold all the positions we had, and we said, okay, put 50% in the TLT, which is the leveraged long T-bond fund or ETF. Now, this is, I don't expect that to be a long-term position. The reasoning behind that is that when money goes to safety, it goes into U.S. T-bonds. And we've been seeing that since that time. The T-bonds have performed very nicely while the U.S. markets are crashing. And so I expect that to happen. But as soon as the calm comes back to the markets, then you, of course, want to consider selling these for the long term. But we see here, the red part, the COT, that's a commitment of traders, small speculators. The red part is when, they've been selling short. The small speculators have been short, and the small speculators are usually wrong. And therefore, this is a very good signal that the T-bonds will rise in price, meaning the yields will decline here at least for a while. And that is exactly what my expectations are.
Real disposable personal income?
This is a very key number for the economy. You don't have to look at much else, but disposable income really tells you what retail sales will do and what the economy will do. It's obvious. If people don't have any money, then things will go down. And you can see here the last part of that chart. Recently, you had a severe plunge in real disposable personal income, and that's a year-to-year change. This means that the economy is not recovering. And, to me, it's amazing. And I ask myself all the time when I see an economist in the media saying, oh, yes, it's obvious that the economy is going to be strengthening for the rest of the year. And I say, can I really be that wrong? Because I'm expecting the opposite. And of course I can be wrong. I've been wrong. And, but I just don't see it. And especially when you look at this chart is telling you exactly the opposite. Real disposable personal income is shrinking. It's now in a deep contraction territory.
Yeah, that's the key point here. It's not just falling off, it's now contracting.
Yeah.
And when I see people like Family Dollar stores close 320 stores, it tells you, and I've done a lot of work on what's going on in retail commercial real estate. And if you don't think that we have a major collapse going on, then you're just not paying attention. The whole real disposable personal income has been dramatically falling. And in concert, separate from that, and I've shown some work on it, is net worth in total has been going through the roof at about $81 trillion. Housing somewhat recovered and stock markets that are up, but it's fewer and fewer people that are participating. And we have a perfect head and shoulders in that regard because it's growing exponentially while real disposable personal income has been barely going linearly and now is shrinking. And asset prices have to be supported by people. And when they can't afford housing, you can't afford cars, it's slow. The last time we've seen these highs was 2000 and 2008 in the ratio of net worth to real disposable personal income.
there you have it, And if you adjust things for inflation, you get totally different charts. Most people, when they hear retail sales, for example, they say, oh, wow, here is retail sales, they were up. Of course, they can't even say that anymore, but that was true in January and February. They were up slightly. But those are not inflation-adjusted sales. Those are price increases that people are looking at. If they would report unit sales, so and so many jeans were sold, so and so many shirts, and so on, you'd get different numbers. You would see that the numbers are smaller. And if you talk to the realtor, they say, yeah, sales are down from a year ago. They said that at Christmas time and so on. And today Macy's came out with a decline in sales. So, these are things that you can't refute, but we always have to be so cautious about the numbers that we get, especially the numbers out of Washington. When you look at the unemployment reports and so on, they are so fictitious. It's like reading Grimm's fairy tales, So don't pay any attention to these numbers. And even the phonied up numbers are miserable, in my opinion. We need 250,000 new jobs a month just to take care of new people entering the labor force. We're not even getting those.
Bert, so that we have enough time to really get to the technical charts, anything else on any of the macro charts that you want to mention?
Well, I think the money velocity is very important. That's the velocity of M3 and M2. Now, that may sound like a fancy term and so on, but it really measures only the turnover of the money in the economy. And you've got here the light blue line is M2 velocity, and the other one, the darker blue, is the M3, money supply M3 velocity. And then basically, if you look at M3 velocity, it shows that the rate at which money has been turning over continues to decline, and we've had this huge decline here over the last 10 to 12 years. And the hiccup that we've had since 2009, since the bottom, is now peaking out. So what basically tells you that all this huge amount of money that the Federal Reserve has been printing and putting out there and so on is not going into economic activity. That's what velocity tells you. And as long as velocity stays down, you cannot have inflation. And therefore, I think the hyperinflation argument, maybe we'll have hyperinflation 10 years from now, maybe in 20 years and so on. But it's not something that would keep me up at night.
Corporations are not investing in capital expenditures. It's in free fall. Small businesses are not investing. Matter of fact, they're pulling back. So that's why the money velocity is falling, and everybody's looking for hyperinflation, which we may get, which is a currency event at some point. But right now, we have an absolute fear of investing, and by that I mean top line growth. All of the earnings today are bottom line, massaged games based on low interest rates and off balance financing, in my opinion. Bert, how does that translate to these technical charts that you have? We are breaking this session at this point and will continue on tape number 2. We have a very large audio and iTunes listener base who have requested that the sessions be kept to approximately 20 minutes in duration. We'll be right back.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.